Imagine unlocking the secrets of one of the most successful investors in history. Warren Buffett, the Oracle of Omaha, has built a fortune exceeding $100 billion. His success wasn't due to luck. It's the result of applying a set of timeless principles that anyone can learn and use to grow their wealth. Today, we're diving into Buffett's top 10 investment principles and breaking down how you can apply them to your own financial journey. Let's get started. Understand what you're investing in. Warren Buffett's first rule is simple but crucial. Never invest in something you don't understand. This principle, often referred to as the circle of competence, means sticking to industries or companies where you have knowledge or expertise. For example, Buffett avoided investing in tech companies for years because he didn't fully understand how they made money. While others chased the dot-com boom, he stayed focused on businesses like Coca-Cola and insurance companies, which he understood deeply. This cautious approach saved him from significant losses when the tech bubble burst in the early 2000s. For you, this means researching the companies you're interested in. How do they make money? What challenges do they face? If you can't explain their business model to a friend, you're probably better off staying away until you've done more homework. Knowledge reduces risk and increases your confidence in making informed decisions. Focus on long-term value. One of Buffett's most famous quotes is, "Our favorite holding period is forever." He believes in finding great companies and holding on to them for decades rather than chasing short-term gains. This approach contrasts sharply with many modern investors who constantly trade based on daily market fluctuations. Why is long-term investing so powerful? It allows you to benefit from compounding. For example, let's say you invest $1,000 in a stock that grows 10% annually. After 10 years, it's worth $2,593. After 20 years, $6,727. The longer you hold, the greater the compounding effect. Buffett often looks for companies with strong fundamentals, such as consistent earnings growth, a competitive edge, and trustworthy management. By focusing on the long term, you can weather short-term market volatility and achieve substantial gains over time. Always look for a margin of safety. A margin of safety is one of Buffett's cornerstone principles. It means buying a stock for less than its intrinsic value, essentially getting a bargain. Think of it like buying a $100 bill for $70. This principle protects you from unexpected market downturns. Even if the company faces challenges, your investment is less likely to lose value because you bought it at a discount. Buffett learned this lesson from his mentor, Benjamin Graham, author of The Intelligent Investor. Let's say a company's financial statements suggest its stock is worth $50 per share, but it's currently trading at $35. This could be a great buying opportunity. However, identifying undervalued stocks requires research. Study financial reports, understand market trends, and be patient. The margin of safety ensures you minimize risks while maximizing potential rewards. Be fearful when others are greedy and greedy when others are fearful. Buffett's advice here encourages a contrarian mindset, doing the opposite of what the crowd does. When markets are booming and everyone is chasing stocks, he advises caution. But during downturns, when fear dominates and prices drop, that's when he sees opportunity. Take the 2008 financial crisis as an example. While many panicked and sold their stocks, Buffett invested billions in companies like Goldman Sachs and Bank of America. His confidence in these businesses and his ability to see beyond short-term chaos paid off handsomely as the market recovered. For everyday investors, this principle means staying calm during market corrections. Don't let fear dictate your actions. Instead, look for high-quality stocks that have become undervalued and seize the opportunity to invest. Invest in companies with strong economic moats. An economic moat is a company's competitive advantage that keeps competitors at bay. Buffett looks for companies with wide moats, which ensure long-term profitability and market dominance. Examples include brands like Coca-Cola, with its unparalleled global recognition, or Apple, known for its loyal customer base and innovative ecosystem. Why are moats so important? They make a company resilient against competition. Without a moat, a business might struggle to maintain its market share, especially during challenging times. To apply this principle, evaluate a company's unique strengths. Does it have patents? A strong brand? Cost advantages? These factors indicate whether it has a moat. Remember, the wider the moat, the safer your investment. Leadership matters. Buffett believes in the importance of strong ethical leadership. A company may have a great product or a strong brand, but if it's poorly managed, it can still fail. That's why he invests in businesses led by competent, trustworthy executives. For instance, when Buffett invested in Geico, he admired the management team's ability to operate efficiently and maintain customer satisfaction. This trust in leadership was a key factor in his decision. As an investor, you should research the people behind the company. Do they have a track record of success? Are they transparent about their goals and challenges? Leadership can make or break a business, so don't overlook this critical factor. Avoid debt like the plague. Buffett has always warned against excessive debt. He believes debt can cripple both individuals and businesses, especially during economic downturns. A company with high debt levels is vulnerable to rising interest rates or declining revenue, which can lead to bankruptcy. Buffett avoids companies with risky financial structures and advises individuals to do the same. For example, using borrowed money to trade stocks. Margin trading can amplify losses and leave you in a precarious situation. Instead, focus on building wealth steadily and responsibly. Look for companies with strong balance sheets and manageable debt levels. Financial stability ensures resilience in tough times and positions you for long-term success. Compounding is the eighth wonder of the world. Albert Einstein called compounding the eighth wonder of the world, and Warren Buffett is its biggest advocate. Compounding occurs when your investments earn returns, and those returns start generating their own returns. Buffett's fortune is a testament to the power of compounding. By reinvesting profits over decades, he turned modest investments into billions. His advice? Start investing early and stay consistent. Here's a simple example. If you invest $10,000 at an annual return of 8%, in 30 years, it will grow to over $100,000. But if you wait 10 years to start, you'll end up with just $46,000. Time is your greatest ally when it comes to compounding, so don't delay. Keep emotions out of investing. Investing requires logic, not emotions. Buffett often says, the stock market is a device for transferring money from the impatient to the patient. Emotional decisions like panic selling during a market dip or buying stocks based on hype can lead to poor outcomes. Buffett avoids impulsive decisions by focusing on the fundamentals. He doesn't care if a stock drops in the short term as long as the underlying business remains strong. To follow this principle, set clear investment goals and stick to them. Whether the market is up or down, stay focused on your long-term strategy. This discipline will help you avoid costly mistakes and achieve consistent results. Live below your means and reinvest. Despite his immense wealth, Warren Buffett is famously frugal. He still lives in the modest house he bought in 1958 and drives affordable cars. His philosophy is simple: spend less than you earn and reinvest the difference. Living below your means doesn't mean depriving yourself. It's about prioritizing your financial goals. Instead of splurging on luxuries, focus on building a portfolio that generates passive income. Over time, these small sacrifices can lead to significant financial freedom. Buffett's lifestyle is a reminder that true wealth isn't about flashy purchases. It's about having the freedom to live life on your terms. These 10 principles have guided Warren Buffett to become one of the greatest investors of all time. They're not about quick riches, but building lasting wealth through discipline, patience, and smart decisions. Which of these principles resonated with you the most? Let us know in the comments below. If you enjoyed this deep dive, don't forget to like this video, subscribe, and hit the notification bell so you never miss an update. We're here to help you master the art of investing, one step at a time. Let's grow together. See you in the next video.